What if I told you there's one simple formula that could cut through all the market noise and tell you if a stock's price is actually reasonable? Well, there is. It comes from decades of investing experience, and today we're going to break it down.
Now, it might sound a little strange to start a conversation about stock prices in a fruit market, but trust me on this one. This simple analogy holds the key to a massive insight about investing. It all kicks off with just buying an apple.
So just imagine this for a second. You're walking through a busy market and you're looking to buy some apples. You walk up to the first stall and you see this perfect, premium-looking apple. The seller tells you it's $500 for that one. But then, at the very next stall, you see a similar-looking one for just $200. The first seller warns you, hey, you can't judge by the outside, that cheaper one might be rotten. And that, right there, is the first big lesson. The price tag by itself tells you almost nothing about the real quality inside.
So you keep looking, because you're after real value, right? And then, way at the back of the market, you find it. A vendor is selling fantastic, high-quality apples for just 1 unit apiece. Why? Because he's already done the work of sorting out all the bad ones. This is exactly what we're looking for, that perfect sweet spot where quality meets a great price.
And that little story? It perfectly illustrates the single biggest question that every single investor has to face. It's the same challenge whether you're buying fruit or buying shares in a company.
And here's the big idea. What if we could apply that exact same logic, finding both the quality and a fair price, to the stock market? If we could pull that off, investing would suddenly stop feeling like a gamble and start feeling a whole lot more clear and logical.
I mean, think about it. You look at a stock ticker and you see a price. Maybe it's 98.3. But what does that number even mean? Is that a good deal? Is the company any good? Is it profitable? Just like that 500-unit apple, the price alone is totally meaningless if you don't know the quality of what you're buying.
So how do we figure out that underlying quality and find a reasonable price? Well, the key, believe it or not, starts in a place we all know very well: the bank.
The entire foundation for this method is the bank's fixed deposit interest rate. You can think of this as our baseline. It's the safest, most guaranteed return you can possibly get on your money. Right now, for example, the rate at Taiwan Bank is 1.47%. Go ahead and burn that number into your brain.
Everything we are about to do boils down to this one incredibly simple universal formula. The money you put in, that's your principal, multiplied by the interest rate equals the interest you earn. That's it.
And the cool thing about a simple equation like this is that we can just flip it around to find any missing piece. If you know the interest in the principal, you can find the rate. If you know the interest in the rate, you can find the principal. This flexibility is the secret that unlocks this entire method.
Okay, so how do we take this basic banking formula and turn it into a powerhouse tool for looking at stocks? Well, it's actually way easier than you'd think.
This slide right here is the crucial translation. The concepts are 100% identical, we just swap out the words. Your principal becomes the stock price you pay. The interest you earn becomes the dividend, which is just the slice of a company's profit that it pays out to its shareholders. And the rate becomes your yield, or your return on investment.
Let's make this super real with a world-class example: the semiconductor giant TSMC. Last year, the company paid out a cash dividend of 4.5 for every single share of stock. So that 4.5, that's our interest.
All right, now let's put that formula to work. We want to find the rate of return, right? So we take our interest, that's the dividend, of 4.5, and we divide it by our principal, which is the stock price. So let's just assume for a moment that we bought the stock at a price of 140. What's our return?
The answer is 3.21%. That means for every share you bought at 140, you earned a 3.21% return just from the dividend they paid out. See, it's really that straightforward.
Okay, so we've got this number, 3.21%. But what does that really tell us about whether this is a good investment? This is where the whole thing just clicks into place.
Remember our baseline, that safe, guaranteed 1.47% we could get from the bank? Well, when you put TSMC's 3.21% return right next to it, the picture becomes incredibly clear. Your money is working more than twice as hard for you with the TSMC stock than if you just left it in a fixed deposit.
And from this, a really simple, logical rule just pops out. If a good, stable company, and you do have to check for quality, is offering a dividend yield that's higher than the risk-free bank rate, that's a huge signal that the stock might be reasonably priced. Why this matters so much
is that it just cuts through all the hype and gives you a solid benchmark for what real value looks like.
So there you have it, a fundamental formula that lets you look right past a confusing price tag and see the potential value hiding underneath. It gives you the power to ask the right questions and, yeah, to finally compare apples to apples. The only question left is, what reasonable price are you going to find next?